Hello and welcome. I'm Catherine Bowie from Pure Financial Advisors, and thank you for joining us for this webinar on navigating retirement solo with Allison Alley, CFP professional. Allison, how are you?
I'm great. Catherine, how are you?
I'm doing really well, and thank you for doing this for us.
Of course.
So,
Well, let's get into navigating a solo retirement. All right, we're going to talk about a few things today, but first and foremost, frankly, whether you're single or not, right, planning for retirement is important, right? And do you know what you would do if you were trying to build your wealth alone? More people than ever are navigating getting to retirement on their own. So let's talk about what that entails. First things first, how do you plan to spend your retirement, right? You have to look and say, do I have enough savings? And then is your plan on track? Currently, 56% of single workers are confident that they're going to be able to retire comfortably. Have you thought about when to collect your Social Security? Did you remember that you might have to pay for private healthcare insurance, right? Even if you reach Medicare age, there's usually additional costs associated with that. Have you built that into your planning to get you ready for retirement? The numbers are actually pretty staggering, but a single retiree could pay anywhere close to $200,000 over 3 decades in retirement for healthcare costs, right? So it can be a big expense if you aren't ready for it. And have you thought about your emergency funds and your estate planning, right? All aspects that factor into getting ready for retirement. 50% of US adults are actually single. I think that's probably higher than a lot of people realize. So there's a lot of people out there planning for retirement by themselves. And that can have an impact on your ability to put away money for retirement. 60% of people that have never been married actually have no retirement savings at all, or any savings. 35% of people that have been married at least once have no savings. So they're a little bit better off, right? That's still a large number of people with no savings, but right, people that have never been married, there's a larger percentage of those. So it's something to you really want to factor in. Let's talk about retirement accounts, right? Given the inability to save, it's not that surprising that a lot of people aren't on course for retirement. When we look at the different generations, right, we're going to break things down by millennials, Gen X, and baby boomers. And we look at the ownership rates by generation. 50% of millennials have retirement accounts. A little bit better, the little bit older you get. 56% of Gen X, currently ages 43 to 58, I should say millennials are currently 27 to 42. 56% of Gen X has retirement accounts. And a little bit better, a little bit older, baby boomers currently age 59 to 77, 58% of baby boomers have retirement accounts. So people are making a little bit more progress the older they get, which is good, but the earlier the better. And we're going to talk about some strategies for that. When we look at average account balances by ages, people currently 65 plus, the average retirement account balance is approximately $87,000. Ages 56 to 64, it's actually a little bit better. $89,000 is the average retirement account balance, but then it starts to drop off, right? Currently, people aged 45 to 54, retirement account balance on average of a little over 61,000. People 35 to 44, current retirement account balances of only about 36,000, and then 25 to 34, only about $14,000 on average in retirement accounts. And people currently age 25 and under, or under 25, I should say, a very minimal amount, right? Less than a couple $1,000s. So lots of work to be done here for everybody. And let's get into that. Let's start off with millennials. So again, millennials are currently age 27 to 42. And most people in this age range are still kind of in that gearing up, maybe a little bit past quite starting out, but building, right? So there's some kind of initial things you want to pay attention to. First and foremost, putting a budget in place, right? A target is to have savings built up of at least 3 times your salary. And maybe not at 27, but as you get through that next decade of your 30s, that being the target to get to a level where your savings is at least 3 times salary. You want to make sure you're managing debt and also start to focus more heavily on retirement account funding. creating a budget first and foremost, right? So things are kind of broken out here into needs and wants, right? And this is looking at a 50-30-20 strategy. 50% of your budget focusing on those needs, right? Housing, food, utilities, the must pay for items, right? So ideally you're looking at spending no more than 50% of your budget on those items. I'm going to skip over here to the far right-hand side because this is frankly the next most important thing. 20% of your budget going towards building emergency funds, starting to build towards retirement and build towards other goals. That might be a home purchase or something like that, right? And then that leaves the remaining 30% for those wants. Clothing, dining out, vacations, etc. And even though that we've got this 30% in the middle, right? That 50 and 20, those are your needs, right? Those are the priorities. If you were to allocate 30% to this middle section first, you probably find yourself without the excess to start funding these things, right? So needs first, wants seconds to really get you along the right path. Let's talk student loans, right? Millennials have a lot of student loan debt. 15 million millennials have student loan debt in a total, I should say $15 million in student loan debt by millennials. The average student loan balance is about $33,000. So starting to get that reined in is going to help you start to fund retirement, fund goals, emergency funds, etc. If you have $33,000 in loans at currently 5%, if you were paying $350 a month, it's going to take you 10 years to pay off that student loan debt. And the interest associated with that is going to create your total payback being $42,000. If you could accelerate that somewhat, and instead of making $350 a month, just bump that to $418 a month, it's going to do a couple of things. Number one, it's going to cut 2 years off your payback. It's going to take it from 10 years to 8 years, and the total amount is going to be $40,100. So you're going to save about $2,000 in interest just by accelerating those student loan payments. Then what you could do with that money, right? If you're finished paying off your student loans, and you could then take that same amount, $418 a month, and start putting it away towards retirement, towards goals, et cetera, and you were to earn an average of 6% rate of return on those dollars over 30 years, that what was a student loan payment could turn into $422,000, right? So it's really looking at the opportunity that's lost by not trying to get those debts paid down as quickly as possible, because you can turn that monthly payment into a significant nest egg for the future. In addition, there is the ability from some employers, a new rule was passed allowing employers to give a matching contribution to your 401k based on you making student loan payments. So if you were putting at least 2% of your annual salary towards student loan payments, employers are now allowed to make a contribution worth up to 5% of your salary towards your 401k, basically the equivalent of a company matching contribution. But it doesn't even require you making 401k contributions. It's based on you making student loan payments. So this is a great opportunity if you are in a situation where you have student loan debt, if you're making your payments and your employer offers this option, it would be great to take advantage of it, right? Because you're paying down debt, but still getting funding into your 401k by your employer as one of the benefits that some employers are now able to offer. So it's worth looking into, see if your employer plan offers this choice. In addition to that, just knowing the funding limits for various retirement accounts is important, right? If you are working and you have an employer-sponsored 401k, the employee contribution limit for 2023 is $22,500. In addition, if you have the cash flow to fund an IRA or a Roth IRA, the current contribution limit for 2023 was bumped up this year to $6,500. So initial ways to start getting money set aside for retirement. All right, let's transition into Gen X, right? A little bit older. Gen X workers are currently aged 43 to 58 and slightly higher savings targets now, right? So goal being that you've got your retirement savings up to at least 6% of your current, 6 times your current salary. And again, maybe not at 43, but as you're transitioning through your 40s and your 50s, that being the goal of getting that savings balance up to 6 times your annual salary. You also really want to be paying attention to your emergency fund, right? If you haven't already built that, assessing where you're at compared to your ongoing expenses. You want to be really trying to focus on maxing out 401k contributions, as well as trying to get as much of your employer match as they're willing to give you. And then taking a look at your retirement plans and making sure that you're utilizing the options available. When we talk about emergency savings, right, general rule of thumb is a goal of 6 to 12 months of your ongoing living expenses set aside in emergency funds. More than half of people don't even have 3 months of their expenses set aside in emergency funds, right? 53% of Gen X has less than 3 months of their expenses set aside. And that's low, right? You want to be able to withstand unexpected things, right? If there's expenses that come up, or you were to get laid off, or any number of other things that might cause you to need additional funds, right? That's the benefit of the emergency fund, so that you're not in a situation where you have no choice but to tap retirement accounts that might have a penalty associated with it, things like that, right? That's the value of the emergency funds. If you aren't in a position where you've built up adequate emergency funds, different ways to do it, right? If you just start setting a little bit aside, here's kind of what that could look like in a couple of short years. If you're able to put $25 a week away, you could build that up to $2,600 over 2 years. If you're able to do a little bit more, and if you could get $50 set aside on a weekly basis, right? You'd have a little over $5,000 in just 2 years. You could do $75 a month, right? You could have close to $8,000 in a couple of years. So little by little is going to get you to where you want to go. It's just chipping away at those goals in a manageable manner. All right, retirement account limits. So the base limits are the same, but now Gen X is approaching 50, if not over 50. So there's catch-up contributions involved. So same base limit on a 401k of $22,500, but people 50 and over can do an additional $7,500. So for 2023, $30,000 is the maximum 401k contribution amount. Roth IRAs, traditional IRAs, also have an additional catch-up amount involved. So again, that base contribution amount is $6,500, but if you're over 50 or over, you can add an additional $1,000. With Roth IRAs and traditional IRAs, there are income limitations involved. So you want to check what you're eligible for. But if you're eligible and 50 and up, $7,500 for 2023 is what you could put aside into a Roth or a traditional IRA. In addition, you really want to pay attention to your available employer match. So in this example, somebody's salary here is $80,000 and their employer is willing to match 50% of their 401k contributions up to 6% of their salary, which means if you were to put in 6%, your employer is going to match 3%. And it makes sense to try to put in at least the amount into your 401k that is going to give you the maximum match that your employer is willing to give you. But here's a few examples. So in the top example, the employee making $80,000 is putting away 4%. So that's $3,200 annually into their 401k. 50% is 2, right? So the employer is going to match 2% or $1,600. So this person's getting $4,800 a year into their 401k. Keep in mind, if they're 50 and over, they're allowed to put up to $30,000 of personal contributions. So this is obviously well below that, but at least they're getting a little bit of the company match. Next example, this person's putting away 5%. So 5% of their $80,000 salary, $4,000 annual contribution. half of that the employer is willing to match, 2.5%, gives them an additional $2,000. So $6,000 a year is going into their 401k. Last example down here, this is how they get the maximum amount, right? So this person's doing 6% or $4,800 into their 401k. The employer's giving their maximum allowed match of 3%. So a total of $7,200 is what this person's getting into the 401k. So again, the more you're willing to do, the more matching you're going to get. All of these examples are still obviously well below the maximum allowable, but at a minimum, you want to put into your 401k what's going to get you the maximum amount that your employer is willing to give you into the account as well. Otherwise, you're just missing out on free money. So you want to get those up. If you're finding yourself off course, let's go through a little bit of math, right? So in this example, this person's 47 years old, planning to retire in 20 years at 67. They are anticipating that in retirement, they'll have fixed income of about $55,000. So that might be their Social Security income or some pension income or a combination of both. But they're currently spending about $80,000. So 47 today, want to retire in 20 years, spending $80,000 today. So you have to factor in inflation to see what you're going to need in retirement 20 years from now, right? So in this example, we took that $80,000, inflated it at 3% annual inflation assumption over 20 years, and that brings the spending need at age 67 to $144,000, which means if they want to be able to spend $144,000 and they're going to have $55,000 coming in from pension or Social Security or whatever, the shortfall is $89,000. So that's your starting point, right? Now you can figure out, well, what do I need to accumulate by the time I get to age 67 so that I can comfortably withdraw this shortfall from your assets that you've accumulated, okay? So here's a couple scenarios. Scenario one, this person that's 47 has already accumulated about $300,000 in their retirement accounts, but they need to get to the amount that's going to be able to provide for this shortfall. In order to figure out what that is, there's something called the rule of 4%, right? A safe distribution rate is widely assumed to be about 4%. What that means is that if you could keep what you're pulling from your own assets to 4% of those assets or less, you could be fairly confident that with a globally diversified portfolio, a reasonable rate of return over time, those assets will then last you 25 to 30 years. So once you've calculated your shortfall, you just take that number and divide it by 4% or multiply it by 25. The math is the same. So in this example, this person's target would be $2.2 million by the time they're age 67. So that's what they would need to accumulate to then be able to sustain withdrawals of $89,000 when added to their fixed income would give them the amount of income they want to live on. So again, back to our examples, the target is 2.2. Scenario one, this person's got $300,000, but they've got 20 more years to get to the 2.2. So what they would need to start saving to get there is $34,000 a year, right? So it's a big number, but if you break it down, it might be manageable. This again is assuming a reasonable rate of return in a diversified portfolio over time. Scenario number two assumes that this person, also 47, 20 years to retirement, but they've already accumulated $600,000 towards that goal. So their savings need is significantly less, $8,000 a year for the next 20 years to get them to that same 2.2. And this just reinforces the benefit of starting earlier, right? The earlier you start, the more you can put away, the more manageable those savings goals become over time. So again, pretty straightforward example, but the goal is to say, hey, here's how old I am. Here's my years to retirement. Map out what you're spending now, what's going to be coming in so that you can calculate your shortfall Again, multiply that by 25 or divide by 4%, same thing, gives you that accumulation goal. And then you can back into your additional savings need on an annual basis between now and then to get you to that targeted goal. All right, Yep, I was just going to say, Catherine, do we have now that before we move on to baby boomers, any questions?
I thought that I'd give you just a couple. So the first one is just when you're referring to saving a percentage of your salary, are you referring to gross salary or net salary after taxes and retirement contributions?
Gross salary.
And then also, you might be getting into this in the next section, but someone has asked about, can you talk about the death of a spouse? So that's why someone is unfortunately single now. And so resulting in a change in tax brackets and, what affects their Roth conversion strategies.
Yeah, absolutely. And we will talk a little bit about it in the baby boomer section, but if you were married and your spouse passed away, there are a bunch of things that change, right? Like, for example, the tax brackets, they basically get cut in half. So you hit higher tax brackets at essentially half the amount of income. So the sooner you can build retirement accounts, especially things like tax-free Roth accounts, right? Once you get into retirement, you'll have more flexibility on where to pull income from, because if you're going to have Social Security income and you've built, 401k funds, you're going to be paying tax on those income streams. So if you could then supplement by pulling from Roths, which then don't continue to increase your tax situation, that's just going to give you more flexibility and choice. So yeah, and in addition to Social Security strategies, which we will talk about in the next section, whether you were married and are divorced or are widowed, that will also have an impact on your choices when it comes to Social Security income.
Okay, we have a couple more questions, but I'm going to let you go through the next section, and then you'll probably answer some of them.
Okay, perfect.
Thanks.
So next generation baby boomers. So currently, and here's a quick one before we get into the ages, right? So one thing to do, and this does sort of relate to what you were just asking about, but whether you were always single or were married and are divorced or your spouse passed away, you want to make sure that you're updating various accounts, right? So if you have insurance policies and retirement accounts, updating beneficiaries to whoever, right? Whether it's children or other family members or friends or whatever it may be. If you do have a spouse that passed away, that's key to make sure that if something happens to you, your assets go where you want them to go. In addition, if you were married and are now divorced, removing former spouses from bank accounts, again, investment accounts, retirement accounts, et cetera. And then, closing or updating any joint accounts that were titled, whether it was jointly or community property or whatever the case may have been, to your individual registration. In addition, we don't really talk too much about estate planning in this today, but estate planning, things like you're updating your trust, updating your will, right? Should you get divorced or have a spouse pass, making sure that those documents now reflect the change in your situation and your current wishes. Big things to make sure you follow up on. Okay, so baby boomers are currently age 59 to 77, and lots of these people are either very close to retirement or obviously already in retirement. And so that savings goal is even higher, right? 10%, 10 times your annual salary is that target savings goal, so that you are sure that you've got the assets needed to sustain you into retirement. You are going to start paying attention to Social Security strategies, really paying attention to those catch-up contributions on 401ks and IRAs that we were talking about previously, as well as paying attention to your overall investment portfolio and your asset allocation. Let's talk Social Security. So most people's full retirement age currently is somewhere between age 66 and 67, but you can take Social Security as early as 62, or you could delay it as late as age 70. There's trade-offs to all of this, right? The longer you wait to take it, the more you get. But the longer you go without taking your Social Security income, and the more dependent you might be on your own assets, depending on your retirement situation. In this situation, or in this example, delaying from taking it early at 62 to 70 gives you a 77% increase in your benefit, right? So in this example, this person's full retirement age is 67, and they are entitled to $1,000 a month of Social Security income. If they were to start taking it at age 62, they would only get $700 a month, right? So that benefit gets reduced. If they were to wait all the way from 67 to 70, that benefit would go from $1,000 to $1,240. So it's a pretty big increase. And if you look at that entire 8-year waiting period, it's a 77% increase. So this is something that you want to factor in to that retirement planning, right? Looking at, well, what other income sources do you have? What's your asset level built to? And when does it make the most sense for you to take Social Security income? And it's going to be different for everybody. In addition, whether you were married before and are divorced or widowed, there's some options here as well. So everyone's entitled to the higher of their own Social Security based on their own earnings record, or 50% of their spouses, whichever is higher. That applies even if you get divorced, as long as you were married at least 10 years, you are at least 62 or older, you're currently unmarried, and your former spouse is entitled to Social Security. If you have multiple ex-spouses, you would collect on, again, either your own benefit or the highest of your ex-spouses. Whichever of those amounts would be higher is what you'd be entitled to. On the other side here, if you are a survivor, so if your spouse passed away, you're actually entitled to 100% of their benefit if it's higher than your own benefit. But you have to either be not remarried or you remarried post age 60. You have to be at least 60, because survivor benefits can actually start as early as 60, whereas spousal benefits and your own benefits can't start any earlier than 62. This over here, it's 50 if you are disabled. And you have to be entitled to your own benefits. But again, if they're less than your former spouse, then you'd get the higher of those two benefits. Here's an example of Dave, who's 62 and a widow. So his wife passed away, his spouse passed away, and a couple different strategies, right? He could start as early as 62 and just claim those survivor benefits now. And in this example, he would be entitled to $1,237 a month. The second strategy, though, is that he would take those survivor benefits now until age 70 and still get that same $1,237 a month. But then at his age 70, he could switch to his own benefit, which had the benefit of waiting those years to get that higher amount. And at age 70, his own benefit would have grown to $1,800 a month, right? So just by strategizing what's available to you, he's increased his monthly benefits by 50% and a 35% increase over his lifetime, just by strategizing and understanding that he's got a couple of options here, right? So that's important to pay attention to. Okay, let's talk catch-up contributions. We were already talking about how people ages 50 and up can have additional contributions to their 401k plans. However, there's a few additional catch-ups for people even older than that. And this is a new rule. So that same $7,500 catch up on the 401k applies for people 50 and above. And again, from ages 58 to 59. However, there's a change now, an additional allowance that was put out there. Starting in year 2025, people ages 60, 61, 62, and 63 can actually make a $10,000 catch-up contribution. So again, you've got that base level 22.5 that you can put into your 401k. If you're 50 and above, you can add the additional 7,500 to give you a total of 30,000. But starting in 2025, if your age is 60 to 63, that catch-up can actually be an additional $10,000. So that would make your total 401k contributions for those 4 years as much as $32,500. And then ages 64 to 70, it goes back to that 7,500. So if you're finding yourself behind, right, in your retirement plan, in your accumulation goals, and you get to these ages and you were able to max fund not only the basic amount, but these catch-up contributions in all of these different age ranges, right? In these first couple of years, that would be 60,000 going into your 401k. The next 4 years, that would be 130,000 going into your 401k. And then these subsequent handful of years, that would be an additional 210,000 going into your 401k. Add all that up, that's getting a reasonable rate of return. We're assuming 6%. Those contributions over that span of time would actually equate to almost $620,000 of additional retirement account balances, right? So they're basically giving people a way to kind of really jumpstart or accelerate kind of in these years as people are getting closer and closer to retirement to make a much larger impact in what they're able to put away towards retirement accounts. All right, last thing I want to talk about is making sure that you're paying attention to your asset allocation, right? As you're getting older, as you're getting closer to needing the money from your retirement account, you really want to make sure that you've built a portfolio that can withstand market volatility, can withstand downturns. A lot of people find, and in fact, the studies have been done, and approximately 59% of baby boomers are actually over allocated to equities or stocks, right? And we've kind of got this little map here showing the different kind of rates of return versus risk levels when we compare various asset class, right? Government treasuries, so T-bills, T-bonds, et cetera, are going to be the lowest risk, but also the lowest return. And then these things just kind of step up. Corporate bonds, still fairly low risk, fairly low return, but a little bit higher on that risk and return scale. Then we get into stocks, right? Large companies, mid-sized companies, small-sized companies. The risk level goes up. So does the projected returns. But if you're close to retirement, in retirement, right? The volatility, the potential for larger downturns is going to have a bigger impact on your ability to ensure that your assets are still sustainable and that you can still have the amount you need to last for your entire retirement. So again, you always want to pay attention to your asset allocation, but it becomes even more important and more vital the closer you are to needing to start withdrawing from your funds, right? You want to ensure you've built a portfolio that can sustain those market downturns. I think Catherine's going to tell us about our free assessment, but I'll also, and let me know if there's any other questions at this point too.
Just had a couple that some are kind of detailed. We've gotten several questions, but some are very detailed. So we might have to do those offline. But one is, and I believe you talked about it. I just wanted to let Elaine know that she asked if her husband and she just split up. They're 64 and 58 respectively. They've been married over 10 years. They're both still working. He's the higher income earner. And will she be able to collect his Social Security benefits when she turns 62? You talked about.
Yeah. So since they were married at least 10 years, once they are divorced, yes, she would be entitled to, frankly, the same as if they were still married, her own benefit or 50% of his, whichever one's higher.
Okay. And then there's another one that says they're in a long-term relationship. They keep their finances separate. They're 38 and 37, and they have no intention of ever getting married. Does this change how we should each invest for retirement?
That's definitely pretty specific. So I don't know how much I could really give on that, but I mean, it sort of depends, right? Even if if they're never going to get married and their finances are always going to be completely separate, but do they like pay for joint goals together, or like is literally every single thing separate? Then you would just kind of want to map out your goals individually to try to target accumulating for those goals. So it kind of depends on how separate it is, right? Or if there's joint goals that they're accumulating towards together, right? That would probably have an impact also.
And then there was one other question that I think we can get. There's other questions, but we'll probably have to get back to them. But one was saying that in our slides, it says that additional savings per year. When we say additional savings per year, and the name of the slide was getting off course, are you talking about savings or investment savings? Like
investments, it should be clear. Yeah, like retirement savings. So whether that's in your 401k, your IRA, your Roth, a combination, retirement savings.
Exactly. Okay. If you have more questions, please schedule your free financial assessment with one of the experienced professionals here at Pure Financial Advisors, and they'll take a deep dive into your entire financial picture and stress test your retirement portfolio. You'll not only learn how to choose a retirement distribution plan that's right for you, minimize risk and maximize return, legally reduce taxes now and in retirement, and maximize your Social Security. You'll also learn how to protect yourself against market volatility, rising inflation, and rising healthcare costs. Remember, there's no cost, no obligation. This is a one-on-one comprehensive financial assessment that's tailored especially for you to get your questions answered. We would just like to thank you so much for being here. Thank you, Allison. I know there's so much information to get to, so it's difficult, but this is our, we try to do these every month so that we can get specific topics. And if you have other topics that you'd like to hear about, please let us know that as well.